Sandy, welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Sandy. So, Steve, let us start by talking about the Toronto condo market. It seems like the pain in this sector is not going to end anytime soon. The Canada Mortgage and Housing Corporation report suggests that while we might not see a crash like the 1990s, the market is still far from a rebound.
Steve, that is right, Sandy. The numbers are quite telling. In August, new condo sales in the Greater Toronto Area dropped to just 118, which is 59% below the same time last year and 90% under the 10-year average. That is a significant downturn.
Sandy, it is definitely a tough time for investors and landlords hoping for a quick market recovery. According to Jordan Nanowski, the lead economist for the Toronto market at CMHC, we might not see a recovery until 2028 at the earliest.
Steve? Yes. And what is interesting is that the millennial demographic, which is the largest now, seems to have almost no interest in these smaller dog crate condos. They are in their peak household formation stage, but are looking for bigger units.
Sandy. That is true, Steve. But Nanowski does believe that these condos will eventually find buyers, especially considering that immigration, although declining, still keeps a floor under demand. It is just that the current dynamics will take time to balance out.
Steve? Exactly. The lack of new construction might help narrow the gap between supply and demand eventually, but it is not going to happen overnight. There is an inherent lag in how quickly the market can respond, particularly with pre-construction sales being almost non-existent right now.
Sandy, for renters and first-time buyers, this downturn might actually be good news. In August, the average condo price in Toronto's 905 area fell by 10.6% compared to last year, and rents have also been on the decline across various unit types.
Steve, that is right. It mirrors a national trend where cities like Vancouver, Halifax, Montreal, Calgary, and Edmonton saw average rents fall. It is a reflection of the wider cooldown in the housing and mortgage markets.
Sandy, so while Toronto might not see strong price appreciation in the condo sector in the next couple of years, there is some movement with developers trying to switch unsold condos into rental units, which could continue to push rents down.
Steve, absolutely, Sandy. It is a complex situation, and it will be interesting to see how things unfold, especially with half of the condos in the Greater Toronto Area being rented out. The under-construction inventory will keep influencing the market dynamics.
Let's shift gears and talk about mortgages in arrears in Canada. It's an important topic because it gives us insight into how households are handling debt, especially in times of financial stress. The Canadian Bankers Association recently released some data on this, and it's quite revealing.
That's right, Sandy. The numbers show that mortgages in arrears in Canada remain very low by both historical and international standards. As of July 2025, the national arrears rate was just 0.23%. This means that less than a quarter of a percentage point of mortgages are overdue by 3 or more months. It's a strong indicator of the financial health of Canadian households.
Absolutely, Steve. It's reassuring to see that more than 99% of mortgage holders at banks in Canada are not considered seriously delinquent. But there's always room for caution. The arrears rate has edged upward recently, and if the employment market softens, we could see a rise in these numbers.
Yes, Sandy, and that's a key point. The arrears rate has historically tracked closely with employment conditions. If we experience a downturn in the labor market, it's likely that the number of missed mortgage payments will increase. However, Canadian borrowers have shown resilience in the past during challenging periods like the global financial crisis, and the COVID-19 pandemic.
That's true, Steve. Homeownership is a major goal for many Canadians, and the country's banks play a crucial role in this. They offer a range of mortgage options and adhere to responsible lending practices. It's all about ensuring borrowers can manage their debt effectively.
Exactly. And when borrowers face challenges, banks are committed to working with them. They offer flexible solutions like lump sum payments, switching from variable to fixed rate mortgages, or even lengthening the amortization period to reduce monthly payments. They can also refer customers to not-for-profit credit counseling agencies for additional support.
It's great to see banks taking proactive steps to support their customers. They understand that healthy banks rely on healthy borrowers. Canadians who are struggling with their mortgage payments are encouraged to contact their banks early to discuss their options. Sandy, let's dive into the recent shift in consumer preferences for variable rate mortgages following the Bank of Canada's recent rate cut. It's been a significant move, ending a 6-month period of stagnant rates and opening up lower borrowing costs for Canadians.
Steve, that's right, Sandy. The Bank of Canada lowered its benchmark interest rate on September 17th, and now we're seeing a notable shift in demand. Borrowers are increasingly drawn to variable mortgages, weighing the potential benefits of a floating market-linked interest rate.
Sandy, historically, Canadian borrowers have preferred fixed-rate mortgages for their predictability and peace of mind. According to Canada Mortgage and Housing Corporation data, fixed rates make up 62% of mortgages in force so far in 2025. But with the recent rate cut, there's a growing interest in variable rates.
Steve, exactly, Sandy. While fixed-rate mortgages are popular, they don't offer the same potential savings as variable rates in a cutting environment. Variable mortgages are now cheaper than fixed ones, with 5-year variable terms starting at 3.7%, which is quite attractive for those willing to take on a bit of risk.
Sandy, and it's interesting to see how quickly consumer behavior shifts in response to these changes. RateHub's internal data shows that in September, variable rate mortgages accounted for 14% of all deals, with 2/3 of clients inquiring about them. That's the highest proportion since December 2024.
Steve, it's a significant increase, Sandy. During the first half of 2024, variable rate mortgages only made up about 4 to 5% of deals. The last time we saw such high interest was during the low-rate era of 2021 to 2022, when the Bank of Canada's rate was a mere 0.25%.
Sandy, the appeal is clear. Borrowers looking to secure the lowest rate and who can handle potential fluctuations are finding variable mortgages to be a smart option. However, it's important to act quickly to lock in the current rates and spreads, as these can change if the Bank of Canada continues to cut rates.
Steve, that's true, Sandy. While most lenders have maintained the full spread between the central bank's prime rate and their variable mortgage rate so far, this might not last. If more rate cuts come, lenders may adjust the spread, affecting the attractiveness of variable mortgages.
Sandy, it's a dynamic situation, Steve. Borrowers should consider their risk tolerance and financial goals when deciding on mortgage options. Variable rates offer potential savings, but they come with the uncertainty of fluctuating payments.
Steve, absolutely, Sandy. It's crucial for borrowers to weigh the pros and cons carefully. Consulting with a mortgage advisor could provide valuable insights tailored to individual circumstances, helping Canadians make the best decision for their financial future.
Sandy, let's dive into the latest report from the Parliamentary Budget Office, which projects a significant increase in Canada's federal deficit. This could spell trouble for mortgage rates, so it is definitely something we need to pay attention to.
Steve? Absolutely, Sandy. The PBO is anticipating the deficit to jump to $68.5 billion in 2025 to 2026 from $51.7 billion in 2024 to 2025. That is a substantial increase, and it is primarily due to increased government spending and slower economic growth than initially expected.
Sandy, right, and this rise in the deficit could lead to upward pressure on bond yields, which in turn might affect fixed mortgage rates. The 5-year Government of Canada bond yields, a major determinant of fixed mortgage rates, have already seen a slight uptick.
Steve, that is correct, Sandy. With higher government spending, there is always the concern that it will push bond yields higher, which could make borrowing more expensive for Canadians in the long run. This is something that mortgage market watchers are particularly concerned about.
Sandy, the PBO report did highlight some specific pressures, such as $115.1 billion in new spending over 5 years and ongoing trade tensions with the United States, which have been affecting tax revenues and increasing deficits.
Steve, yes, and while the report did not specifically mention defense spending to meet NATO targets or the plans to cut public service spending, these factors could also play a role in the fiscal landscape. It is a complex situation with many moving parts.
Sandy, with the larger deficit and weaker fiscal position, we might see higher government borrowing costs, leading to higher bond yields. However, there are other factors that could influence this, such as a potential increase in demand for Canadian bonds, which are seen as a safer investment compared to stocks, especially if the economic outlook worsens.
Steve, that is an excellent point, Sandy. If the appetite for Canadian bonds grows, we might see yields decrease, which would be beneficial for fixed mortgage rates. It is a delicate balance, and the recent descent in bond yields has already brought some relief to fixed rates.
Sandy. Meanwhile, variable rates have also been affected, dropping last week after the Bank of Canada cut its benchmark rate for the first time since spring. This dynamic situation makes it crucial for borrowers to stay informed and consider their mortgage options carefully.
Steve, absolutely, Sandy. For Canadians looking at mortgage options, it is important to keep a close eye on these developments. Consulting with a mortgage advisor can provide clarity and help in making informed decisions tailored to individual financial goals and risk tolerance.
Let's dive into the latest forecast from CIBC Capital Markets, which suggests that Canada's mortgage market is on a slow recovery path, primarily due to persistent trade tensions. It's a complex situation, and the bank indicates that while a soft landing is likely, there are significant risks that could prompt further policy actions.
That's right, Sandy. Avery Schenfeld, the chief economist at CIBC, points out that since the trade conflict began, Canada's main strategy was to reverse its effects. There's some progress, like potential easing of U.S. tariffs on aluminum and autos, but businesses remain cautious about investing in Canada if they're targeting the U.S. market.
Exactly, Steve. Schenfeld also mentioned that while exports are expected to improve, getting back to full employment will require a Plan B. This could involve increased infrastructure spending, efforts to diversify trade, and more support for home building. It's all part of a broader strategy to boost resource export prospects.
And let's not forget the impact of the Canada-US-Mexico agreement. CIBC's outlook is contingent on Canada maintaining its free trade access under this agreement. If that fails, or if the U.S. imposes broad tariffs, further rate cuts might be necessary in 2026.
That's a crucial point, Steve. The Bank of Canada is anticipated to deliver another quarter-point rate cut, which could offer some relief to variable and short-term mortgage borrowers. However, the report also notes that longer-term yields might remain elevated due to U.S. fiscal deficits and increased Canadian bond supply.
Yes, Sandy. Despite the potential for short-term relief, fiscal policy is expected to remain tight. Federal budgets are likely to focus on capital projects, which may take years to impact the economy. CIBC also highlights the significant role of AI-driven capital spending in the U.S. and the effects of slowed immigration on labor force growth.
It's interesting to note that CIBC projects GDP growth of 1.2% in 2025 and 1.4% in 2026, with unemployment hovering around 7%. Housing starts are expected to rise modestly, but business investment remains subdued due to trade uncertainty.
That's correct, Sandy. While the forecast might seem somewhat comforting, Schenfeld warns that the recovery will likely leave excess slack in the labor market through 2026. it's not a guaranteed outcome, and the markets might be overly optimistic about the recovery pace.
Indeed, Steve. The situation underscores the importance of staying informed about these developments. Borrowers and investors should keep a close eye on trade negotiations and economic policies, as they play a crucial role in shaping Canada's mortgage market outlook. Sandy, let's dive into the recent news about the Canadian economy's performance in the third quarter. According to Bloomberg, it seems we're on track to avoid a recession this year, with a strong rebound in the third quarter.
Steve, that's right, Sandy. The industry-based gross domestic product expanded by 0.2% in July, which was better than expected. Statistics Canada's advanced data also suggested that output remained unchanged in August, breaking a streak of monthly contractions since April.
Sandy, if there is zero growth in September, the economy would still grow at an annualized pace of 0.7% in the third quarter. That's a significant improvement from the contraction we saw in the second quarter. However, economists surveyed by Bloomberg expect slightly weaker growth of 0.2%.
Steve, interestingly, the Bank of Canada has a more optimistic view, projecting a 1% growth. But we might see adjustments in their forecast when the interest rate decision and the monetary policy report are released on October 29.
Sandy, the loonie also reacted positively, reversing losses after the GDP report and edging higher. Meanwhile, Canadian debt remained steady, with a slight dip in the two-year yield. It's encouraging to see some stability in the financial markets.
Steve, indeed Sandy, the Bank of Canada recently lowered borrowing costs for the first time in 6 months, aiming to support an economy that's been weakened by falling exports and business investment. However, consumption and housing activity have remained healthy.
Sandy, yes, but the policymakers are cautious, anticipating slow population growth and a weak labor market to moderate spending. Economists even predict further interest rate cuts this year.
Steve, at the start of the third quarter, goods-producing sectors showed stronger than expected growth. For instance, metal ore mining and oil sands extraction saw significant increases. Even pipeline transportation saw its largest growth since September 2022.
Sandy, Charles St. Arnaud, the chief economist at Alberta Central, shared that while the economy is not deteriorating, it's also not rebounding robustly due to weak business and consumer confidence. He noted that economic activity in July was still slightly weaker than in March.
Steve, that's a valid point, Sandy. St. Arnaud also mentioned that whether the economy continues to improve may depend on whether the current low economic activity leads to further job losses. The Bank of Canada is expected to remain cautious, potentially cutting its policy rate again this year.
Sandy, Andrew Grantham from CIBC highlighted the importance of upcoming employment and inflation releases in determining whether the Bank of Canada will make another rate cut in October. It's a critical period for monetary policy decisions.
Steve, Benjamin Reitzes from the Bank of Montreal, however, sees no increased urgency for the central bank to cut rates, suggesting that the current economic indicators don't necessitate immediate action.
Sandy, in July, the auto parts manufacturing sector jumped 10.5%, and motor vehicle manufacturing rose 9.1%. This coincided with higher exports, especially since seasonal adjustments were less pronounced due to U.S. tariffs.
Steve, yes. Sandy. The steel industry, however, has been hit hard by the U.S. tariffs, with activity in iron and steel mills and ferroalloy manufacturing plunging 24.8% between February and July.
Sandy, despite these challenges, some momentum continued into August, with increases in wholesale trade activity helping to offset declines in other goods-producing sectors. Retail trade also seemed to bounce back after a contraction in July.
Steve, it's a mixed bag, Sandy, but the overall economic outlook appears cautiously optimistic. It will be interesting to see how these developments influence future policy decisions and the broader economic recovery.
Sandy, welcome back, listeners, to the Ontario Mortgage and Real Estate Insights podcast. As we wrap up today's episode, let's turn our attention to the intriguing developments in Canadian real estate prices. Despite the slowdown in population growth, home prices across most of Canada remain resilient, nearing all-time highs, except notably in Ontario and British Columbia.
Steve, that is right, Sandy. According to the Canadian Real Estate Association, the national benchmark home price in August was $686,800, down 19.4% from its peak. However, this correction is primarily evident in Ontario and British Columbia. The other provinces have not only resisted this trend, but have seen prices hit record highs within the past year.
Sandy, it is fascinating, Steve. While Ontario and BC have seen significant price declines, Ontario by 25.6% from its peak, other provinces like Newfoundland are experiencing new record highs. This disparity raises questions about the underlying drivers of these regional markets.
Steve, absolutely, Sandy. The correction in Ontario and BC is largely attributed to rising interest rates, which have made these already expensive markets more sensitive to monetary policy changes. In contrast, other provinces benefit from relative affordability and have not felt the same impact from rate hikes.
Sandy, indeed, Steve. It seems that lower price points in other provinces make them more responsive to credit stimulus like rate cuts and extended amortizations. Moreover, interprovincial migration and what's termed as bubble contagion have also played a role as buyers move away from high-priced markets, pushing prices up in more affordable areas.
Steve, that is an interesting dynamic, Sandy. It appears that while population growth has been slowing, it is not the primary factor influencing home prices. Instead, the availability of cheap credit has been a significant driver. The real estate market's sensitivity to interest rates is a classic example of monetary policy at work.
Sandy, yes, Steve. And while some regions are seeing record highs, the gap between expensive and more affordable markets is closing. For instance, the condo price discount in Halifax compared to Toronto has shrunk significantly. This trend could persist as long as buyers remain in their own bubble, unaffected by broader market corrections.
Steve, precisely, Sandy. It is a complex landscape, and the market's resilience in most provinces suggests that while Ontario and BC undergo corrections, other regions may continue to see growth, albeit cautiously. It's important for investors and homebuyers to remain informed about these regional dynamics.
Sandy, absolutely, Steve. As we conclude today's episode, it's clear that the Canadian real estate market is navigating a period of significant change with varying impacts across the country. Staying informed and understanding these nuances is crucial for anyone involved in the market.
Steve, thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Sandy, before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.